so let's go ahead and delve in. I wanted to start by, you know, do you know your business? I mentioned earlier that audit starts, or the auditing process or the assurance process starts with risk. And do you know what the risks are in your business? And it applies to your personal life as well. Do you know what the risks are in your personal life? Take a look at this picture and tell me if if you can tell me what some of the risks are in this picture. I don't know if you can see it from back there, but do you see any risks in this picture? What do you see?
If one person stops, if they're all so close together, they might all
Yeah, they sure are. Yeah.
collapse.
What else? Anything else you see in there? You notice that the back wheel, there's no back wheel in this bicycle here. So, you know, sometimes the risks aren't always that obvious. You know, you're right, that was one of the risks, that they're close together, that they're in a bike race is a risk, right? So understanding the status of your compliance initiatives, your employees' behavior, how does your organization govern itself, and asking yourself the simple question, what could go wrong? You know? And that's the way we build audit processes. We ask the question, what could go wrong? What are the risks? And we always also say we only have risks really against objectives. So if you're not clear in a business what your objectives are, you don't really know what your risks are. So we have objectives like growth, safety, compliance, cost reduction, and all of those are goals in a business. So our risks are things like, what if we're not compliant? What if we have an accident? What if our earnings aren't good enough? What if our stock falls? What if our statements aren't done right? So that your risks are always tied to your objectives, and you want to be clear about your objectives. Okay? So let's talk a little bit about why audit needs to change. Okay, so what's the current state that we have in auditing today? Well, we have most controls are monitored manually. I just did a little survey here, and you guys told me you did a lot of sampling, okay? And that's how we do auditing today. And I hate to tell you this, but it's woefully inadequate. Because even though in a T-test n equals 30, you know, there's people that propagate the idea that that's an adequate sample size. I would argue that if you're, and so would good statisticians argue that there's no mathematical proof for n equals 30. And if you just think about it, if you're taking a sample of high transaction volume things like accounts payable, accounts receivable, and you take a sample of 30, do you really think you're finding problems, if there's problems in that data? With a sample of 30 out of 100,000, out of 1,000, you're not finding. I'm sorry. You know, and the reason we know that is because when we put population-based testing in against the same processes that the audit firms have given attestations on, we find hundreds of things wrong, thousands of things. In one big division, the company I worked with, we found $700,000 of duplicate payments and invoices in one division the first time we ran a continuous auditing module against the data. And that was data that had approval, the process was approved and signed off by the internal auditors, by the big 4 external auditors, and we find $700,000 of problems. So, you know, I'm sorry, you know, taking a sample, and what they did is they took a sample of 30 of those receivable transactions. We're not finding it, okay? Critical controls go untested. One of you shared in here that you use a threshold. So we do a threshold. If it's over this amount, we're going to test it. Well, what do you think people that commit fraud do? They say, well, they're only checking things that are over, and your accountant, no, they're only checking things that are over this amount of money, so I'm going to do my fraud on things that are below that amount of money. It's just not effective. Control breakdowns are identified long after they occur. So we come in once a year and we do a financial audit, and a SOA audit, our sarbanes-oxley audit. By the way, if I use any acronyms that you don't know, please raise your hand and say, what does that mean? Okay, because we throw around all these acronyms in accounting and auditing, and most people don't know what they are. And so, you know, we may find something that happened in January and December. 20 things have changed since then, and by the time I get the audit report written, it's now January, February of the next year, and it's, you know, it's either immaterial or it's too late. And CFOs are signing off on imperfect information, so they don't know what the state of their business is. So And the other thing is excessive costs. You know how much it costs to field an auditor? It costs about, the rule of thumb is you have one auditor for every 1,000 people in your company. Okay, so in a company, a large company, an international company that has 100,000 employees or something, you may have 450 auditors. And the average auditor costs about $175,000 to $250,000 to field, and that's not the partner. That's the, because if you think about it, you take the salary you get, plus the burden at 30%, plus the travel and entertainment. I sign travel reports for people that spend $250,000 a year traveling to go meet with Sophia and say, can you give me this information, please? You know, and then tie it off on a sample. You know, huge amounts of money. That's the biggest cost in auditing, is that travel cost. Unnecessary risks and fraud. I told you before, we're not finding the fraud. We're not getting at it, and I'll show you that from this report here later. Wasted time and effort. Okay, so we're spending intelligent MBAs, and we have them doing a lot of taking information out of SAP and putting it in a spreadsheet, and then doing analysis of the spreadsheet, and then putting it into a Tableau thing and trying to report it, and your expensive middleware. And inefficient business processes. A good auditing process demands an efficient business process. Tiffany mentioned that she's doing her PhD work in this thing called process mining. Does anyone know what process mining is? Have you guys heard that term in your training here? Yeah, okay. So that's a key thing where we're also set up controls and processes. And you know what happens with processes is people take the path of least resistance. So you have a data flow diagram that shows a certain process, but that's not what people really do. And you set up a control process that assumes people follow a certain process, but people take what we call elephant paths. You know, at the university, when you have the sidewalk that went like this and turned like that, you didn't go up there and go like that, you went across. And that's what people do in business. And so you have controls that assume people are following a certain process, and that's not the process they're following. So you're not even in control, and the process mining is a great way to validate that people are finding processes and to insist that people do follow processes. Because if we don't have them, oh, there we go. Okay. So, but despite all of these things, sarbanes-oxley signed off in 2002, cost millions of dollars in the average company to implement. The scandals keep happening, right? We're not stopping it. So I talked about the latency, why auditing needs to change. Let's talk about, again, your work-life thing. We mentioned that. You guys are expensive middleware. You got your undergraduate degrees in psychology and accounting and economics and law and other things, and political science. And now you get your MBA and you spend all this time burning yourself out here for 15 months or whatever. And now you're going to go out and we're going to make you do stuff that your 4-year-old daughter could do, transferring data between systems. Okay, so and the other thing is the travel. I shared with you, I traveled all over the world for 7 years with you guys, and we all burned out. And we all said, and everyone thought it'd be fun at first, but it gets old. Sitting in an airport for 13 hours, and you start wondering, what am I doing here? So, and then I mentioned this before, non-statistical sampling. So what we're doing is we're going out and taking n equals 30, and that's what we do today. We go out and we take samples on huge data sets, and as we normalize and combine data sets, we don't change the n equals 30, and you know why? Because if you did, you'd have to, your KPMG, Ernst & Young, wherever, you'd have to double, triple, or internal audit group, you'd have to double, triple, quadruple the size of your audit staff in order to do a statistical sample. If we did real statistical sampling, and again, there's a lot of argument in the audit field that n in 30 is acceptable, all it does is it gives you the first touch point on possibly having a normal distribution. But in a huge data set, you're taking a sample of 30 in millions or hundreds of thousands of transactions, you're not finding this stuff. I'm sorry. We're just not finding it. So we got to look at, and we have the technology today, and I'll submit to you the problem today is not that we don't have the technology or the trained accountants and auditors, because we do, because this stuff is no harder than using what you use every day on your things. It's a culture problem. It's something that we got to change. So we have non-statistical sampling methods, again, if we did a confidence interval of 99 or 95% in that 100,000 transactions, we would need 100 more accountants, auditors, to come into the firms and check this stuff out. Now, some of you mentioned you did do population sampling on equity trades or something like that, maybe where there's a small number, or hedge fund accounting or something where there's a small number of transactions, then you do the population review. But you're not doing population reviews on, on T&E, on accounts payable, on accounts receivable, on high transaction things. But we have no choice. But it's woefully inadequate. That's my message and my point. And we need to challenge the paradigm. And it's great. And it's not a criticism of anybody. It's just that we're using a process that's really old to do something that was developed when we didn't have the ability to use technology. And now we have the ability to use technology. And where is all the data today? Where does the data sit? Is it in paper form in most places? Andrew, where does it sit? Servers, systems, and now more and more we're getting relational type databases and optimized databases. Anyone here know what? Anyone use SAP here? No? No, you have. Okay. Where'd you use SAP?
It's HR system.
In HR, SAP HR. SAP has a technology, that database technology called SAP HANA. We'll talk about this later, but what they do is they take millions of records from all these data warehouses and they optimize it and they store it all in RAM memory. So you have what they're called real-time analytics, because everything is available in RAM memory, and they do use optimization to do it. And when I share with you about blockchain, that's even more interesting. So so we have the technology, we have a culture problem, and sometimes it's auditors that are in the way. Okay. All right. Another thing is, if you think we're doing a good job, how many know what the PCAOB is? Anybody know what's PCAOB, Calvin?
They're the auditors for companies that audit.
Right. They audit the audit firms, right? And if you go out to their website, PCAOB.com or something, there are reports on all the audit firms, okay? And I won't mention this audit firm, but this is a Big Four audit firm, okay? And I just want to share with you a little bit about this report that was done in August of 2016 by the PCAOB, okay? And I'm just going to highlight, it was done on 54 issuing companies, and if it's a Big Four, you can imagine they're large organizations, okay? And if I go through this, it's pretty big. I'm just going to read a couple of excerpts from it. In this audit, the firm failed in the following respects to obtain sufficient appropriate audit evidence to support its audit opinions on the financial statements and on the effectiveness of ICFR, internal controls for financial reporting. Now, it didn't say the firm could do better or didn't do a good job. It said they failed, okay? Which could be implied, materially failed. The firm failed to sufficiently test whether fair value existed on VSOE, that's for the IFSR requirements. The firm failed to perform sufficient substantive procedures to test certain aspects of revenue recognition for multiple element arrangement. The firm failed to obtain sufficient appropriate audit evidence to report its audit opinion on the financial statements of the company and the effectiveness of ICFR. The firm failed to perform sufficient procedures to test the valuation of the issuer's mortgage loans. Now, are those hot buttons or not? Revenue recognition, more collateral mortgage things, multiple element transactions. I mean, this is not, that petty cash was off by 25 cents. The firm failed to evaluate whether this control was designed to prevent or detect material misstatements related to identification of long-lived assets that might not be recoverable. The firm failed, the firm failed, the firm failed. I mean, this is the worst audit report I've ever seen. Now the PCAOB is not noted for throwing flowers, to the companies they audit, but I've never seen a worse audit report than this. And it doesn't matter which company you pick up. Go out there yourself on the website and look it up. They're all like this. So even in the eyes of the people responsible for regulating that, the job is not adequate. Okay? And the firms respond every year with letters that say, well, we're committed to excellence in audit and we're going to do better. Well, we got to start doing better. And I'm telling you, you're not going to do better by taking more samples, writing better documentation, and that's some of the recommendations you get. Now, in fairness, the PCAOB is starting to step into the water around using technology. They have a technology research group that's starting to do that, but it's in its infancy stages, and in those organizations it takes a while to change. Okay? All right, so that's another reason. So the other reason that may be most compelling is that I mentioned to you this report to the nations that we'll cover in one of the classes here when we do fraud, but this report, which is based on 1,400 to 2,000 actual companies' actual frauds, it points out that 47% or so of all fraud is collusive. That's meaning, what's collusive mean, Matt?
They're working together.
Working together. There's more than one person involved in the fraud. Okay? And almost all, in a prior report, almost all financial fraud is collusive. Okay? So tell me, if how do we build control requirements? Do you know how control requirements are built? What they're based on? It's on the slide. John, what are audit requirements based on? For
the 4 eyes.
4 eyes principle. And what's the 4 eyes principle?
Well, there's gonna be 2 people. I mean, like one person actually does the work, and
right.
another person, like they
Checks the work.
Well, in my company, they used to have the 6 eye review.
6 eye. Okay.
Yeah, 6 eye. We used to have a 6 eye review.
Okay.
My system.
But even then, when I show you, I don't have the slide on here, but we'll show it later. Sometimes it's 5 people doing the fraud. You know? So what happens is that, right, you're right. The whole internal control process is based on 4 eye principle, which will never find collusive fraud. So what will find collusive fraud? Well, I believe, and the research shows this, that you'll only find collusive fraud by creating a perception of monitoring using technology, which is population-based continuous monitoring. And that's what we're going to talk a lot about in this class, okay? So as an example, when I worked at Siemens or Armstrong or other places that I've worked, we monitor on a population continuous basis what people do on the internet, where they go on the internet, okay? To make sure people aren't, you know, looking at porn sites or running businesses outside of the company. I had absolutely no temptation to go to a porn site or to run a business outside the company because I knew I was going to get caught. Okay? But if I know that all they're testing is a sample of 30 on T&E expense reports in a company with $2 billion of travel expense, you know, it's not a big risk to do something wrong. The perpetrator conceal a fraud. And again, I want you to understand that when people do frauds, these are not scumbags. 87% of them are first-time offenders, no criminal record at all. So check backgrounds till you're blue in the face. You're not going to find them. And you know, and they're usually respected people. One thing, and in fraud, 3% of the frauds that are found by external auditors. So knock yourself out with going out and sampling because you're not going to find them. 14% are by internal auditors that know the business better. And the balance of the few that are found, and my contention is we're not finding them, are found by tips and hotlines and things where people telling one another. Okay, but so we're not finding the frauds, you know, and it's a serious issue. And the control environment, the only way we're going to stop fraud is take away the opportunity. And by the way, when you think about controls, never put anybody, you know, Mike or anybody who's a respected person in a position of power or where they can perpetrate a fraud. Even if you trust them, they're wonderful Christian, Muslim, you know, background people that are committed to their values and all that. It doesn't matter. Because Lord Acton said that power corrupts and absolute power corrupts absolutely. That's why our movie stars and our athletes get in trouble, because they have too much power in their lives. They can do whatever they want. And you put someone in that, they're not bad people, but they get corrupted by power. So we should design systems, design processes, and design audit controls so no one can do that. So with these things in mind, you know, this is why I'm going to make the statement, you know, that what we're doing in audit today is woefully inadequate. Not just it needs tweaking. The PCAOB says it about at least the financial audits. Okay? The fraud report says 5% of revenue we're losing, you know. So we got to do something different. And you know, your own quality of work life maybe says that what you don't want to do is work 70 hours a week, you know, taking samples and tying out samples manually when you know where that data is. Okay, you got it? Any questions on that? Do you agree? And by the way, in this class, I like you know, it's okay to say I think you know, sample-based things are adequate today in most areas. I know. Does anyone disagree or anyone feel differently? It's okay to, you know, I like you to disagree with me. That's a good thing. That's not bad. Is it adequate?
Do you make the company smaller? Because when I was interning, I had a larger company. It was like a KPMG company. Then I had a private company as well. It was a really small company, so even by sampling, we took everything that was like anything, and our threshold was pretty low. So I felt like sampling was pretty accurate. But I don't know if it makes a difference.
Well, what's interesting in this report is that on a percentage basis, there are higher losses in nonprofits and small companies than in large companies. And there's more incidents of fraud in smaller companies because they don't have the ability to have some segregation of duties. But yeah, I mean, you know, in a small company, like I'm working at a startup now in New York, and we're like sharing the office with 3 other people. I'm the risk officer from CISCO Corporate. You know, I'm like, you know, what kind of security do we have here? You know, and this idea, and I was guilty of this as a controller in Armstrong. I said, well, I hire good people like Sophia and Pietro, and I trust them. So I trust my people, and we have a good relationship. But that doesn't matter because people do fraud for very altruistic reasons. So for example, if I'm doing earnings management, what am I doing? I'm changing provisions or something in order to make money in the company because I live with you guys. I spend more time with you, you know, in my company than I do with my family. And I don't want you to lose your job because if you lose your job, you can't feed your family. And so I'm going to adjust this provision just this quarter. It's coming back next year. And I'm going to help my friends out, you guys. You know, so I'm not doing anything wrong. Or my, you know, grandmother has no medical insurance and she has cancer, stage 4 cancer, and I'm going to borrow this money from the company for a little bit, and I'm going to pay him back, you know, and I'm going to help my grandmother out, you know. Or, you know, Stephanie makes $100,000 more than me, and I work a lot more hours than her, and you know, so I'm just taking the money that I deserve because you know I'm doing a better job than she is, and I'm working harder than she is. So why shouldn't I have that money? They just didn't give it to me. That's the rationale part. So, but good point. Yeah. Anyone else? Any pushback on that? Yes.
This is just a question. I just wondered what PCOB says about the exercise, because they said that in the report about public accounting firms are not doing a good job in when they're reporting audit. But if they think that sample size is not big enough, shouldn't they increase the number of the requirement?
Yeah. But think about that. So if they said tomorrow the guidelines, and by the way, the PCOB, the IAA, and other standard setters, they do not restrict using technology. In fact, they do encourage it. Not real strongly, but they encourage it. But if they did say something like, and that's a great question, you know, we want you to use a statistically sound sample based on a confidence level of 99%. Then when you went out to run your test, you would have to take a huge sample in those 100,000 million high transaction volume things. And you couldn't do it. You'd take the sample, but you'd have to hire, you guys would be great for you guys. We'd be hiring more people in accounting than you could ever imagine. But what did we say earlier? It's a cost thing. They're not going to do it. They know that. They all come from, you know. That's why I'm saying, what I'm trying to say is that and that's a great point. They're not going to do it because we all know we can't do it. And if I'm an internal audit department and I'm paying $50 million a year in a large multinational company to hire Ernst & Young to do my audit, and they tell me, you know, we're going to use the new PCOB requirement for statistical sampling, and now we need $200 million to do the audit. What do you think the management's going to say? No way. So it's a cost thing, you know? But it's more than that. You know, it's a quality thing. You know, we get in the job done. We're not getting the job done. Good question. Any other thoughts on that? Yeah.
So like if you audit the whole population, you're gonna find all sorts of little types of fraud, and you get caught up in those as opposed to focusing on like some really big material factors.
Yeah.
And you're like, and when you're dealing with like pharmaceutical companies, like with revenue,
Yep.
it's really crazy because they could be making $1 million, invoices every single day, and it doesn't seem like a big deal because a big invoice could be $50 million.
Yep.
And you can catch a couple of small frauds and it's only $3 million, but what about the really big ones?
Yeah.
I think that's kind of a big thing. Like, that's a huge population. Finding too many ones.
Yeah. That's a great critical thinking, Fred. That's what I'm looking for. People think like that. That's exactly some of the other issues. Is that and the idea of this is let's do population auditing on the high transaction commodity type routine things, and then let's trade up what auditors do to the more forensic, strategic kind of money laundering kind of things that are harder. Because let me be clear in this class from the outset, you can't automate everything. There's a lot of things that go on that are schemas, fraud schemas or something that you can't automate everything. But what you do is what happens today is because we don't have intelligence and transparency a lot of times in audits, we hand you this audit plan that's 450 pages for accounts payable, and even if you find something that might lead you to that multi-million-dollar thing, you're not going to chase it because you got 4 auditors and you're on a budget and you're going to do the exact same thing you did last year. Where if I had even data mining analytics, I can go in and say, hey, you know what, the 3-way match looks pretty good. I'm not going to audit that, but we're going to follow this other trail. So great question. The idea is how do we allow auditors to trade up to the more interesting forensic stuff? And that's the stuff that's interesting, is figuring out, getting your head in the mind of a CFO that might be committing a fraud and figuring out what he's doing and tracing that. And the other thing he brought up is a really good point, is that one of the challenges that we had in the audits we did at Siemens and other places and other companies is that when we put technology in, we find thousands of things. So what we do is an audit cleansing. We raise the, I can give you guys a break here. We raise the threshold from, we're only going to look initially at the ones over 50,000, even though we have the whole population. But let's get them solved first, then we'll go down further and get the other ones. Because I had one audit head say to me on a T&E audit where we had thousands to find him, say, you know what, I'm just going to go out and sample again because I don't know what to do with all this. So instead of finding a needle in a haystack, you're finding millions of needles and you don't know where to start. And the other thing that happens is, talk about latency, now you got the opposite problem. You're finding problems constantly, right up until you have to turn in the audit report. You're still finding anomalies. So what do? You sign off on the audit report, say everything's fine, when every minute it's finding something else. That's how pervasive it is. But those are the challenges that we got to work through. But to say, well, because of that, we're not going to do it. We're not going to use the technology. We're just going to put our blinders back on and put our head in the sand. And we're going to, it's ludicrous. I mean, as a stockholder, that's not comfortable with me. But that's exactly the kind of things that we run into. And I'll share some stories about when we put technology in. Many of the auditors told us, the external auditors, okay, we still want you to sample. You're like, wait a minute, I just did the whole population. I got it all documented, and you want me to go out and sample. Yeah, well, the PCOB, we're getting in trouble with them if we don't do the sampling. So now what we've done is we've created more work, And I don't think people realize the level of control, precision, and insurance you get by doing population continuous audit. I mean, it's over the top, So, a change in audit and what needs to change. So one of the things in audit is, maybe one of the ultimate conflicts of interest is that I'm paying an external auditing company to audit my books and find me doing things wrong. Okay? Does that sound like a little bit of a conflict of interest? This is just a little slide that I swear to the best of my knowledge, which is pretty poor, maybe revised in the future, my company accounts are more or less accurate. I checked this with my auditors and directors who I pay to agree with me. So, from the outset, we got a little bit of conflict of interest with external auditors, but we try very hard, and the external auditors work very hard to make independence is very important. So, what independence is in auditing, that means that, I can't come in and tell you what controls are important in your company and then come in and test the controls that I gave you. That's a violation of independence. I can't be your external auditor and also be your internal auditor, because that's a set, you want an independence between them. And I can't be a member of management and be your external auditor. And they even, under sarbanes-oxley, after the Enron things and everything, they separated the advisory groups from the audit groups. So, is anyone going in to join the advisory groups, or is it all audit or tax that you guys are doing? Audit tax, yeah. Those are interesting too, because they do a lot of this research type stuff and project type stuff. It might be an area that you want to also consider when you go into the firms, okay? So independence is very important. We don't want an auditor. And now there's rules around the audit managers need to change every so many years, so they're not in bed with, you know, with General Electric or with the company that they're working for, you know? So, okay, so, another reason that audit needs to change is what's happening now is when companies are found doing things wrong, a lot of times the company gets convicted and gets charged. Siemens is an example. We got a $1.6 billion fine, that's B as in $1 billion fine, for corruption, which is bribery, okay? And that was from the Department of Justice and the SEC and from the German regulating authorities. And that was and Siemens didn't bribe anybody, but they did have an intermediary, you know, come along and say, hey, I'll go get you this, you know, energy power plant or whatever contract in Venezuela or Nigeria, wherever. And they go out and they get that contract for you, and you give them $6 million for getting the contract, and they were basically an outside salesperson. But you're responsible under the Foreign Corrupt Practices Act signed in 1977 for that, as bribery. And now the UK law is even stricter, and this stuff is happening. Now, I don't know if you know this, but in a lot of countries, and maybe some of you come from these countries, you can't do anything without bribing somebody. You know, I had an employee in Nigeria. You can't get out of the airport in Nigeria without bribing somebody. You know, just to let you out the gate. So, you know, so it's a tough thing, but it's really important that we deal with that, because, you know, countries that have corruption and bribery on the corruption index, their GDPs are 17 or 22% lower than companies that don't. And so it hurts the company. You know, we gotta, that's another reason we gotta audit. We gotta get this out of there and deal with it. But what's happening now is this is an actual case in the Justice Department where a guy named Garth Peterson admitted to paying off Chinese officials with a bribe, and they brought action against Garth, but not against the company, because the company had and was using, you see down here, the company was using, they were using monitoring, automated monitoring in the company. And because they were using automated controls in the company, they were not, the company wasn't charged with bribery, the individual was. And that's important, because you know, it could be huge for companies. You know, just think what a $1.6 billion fine does to your bottom line. That comes right out of your net income. You know, I mean, so more and more, you know, even the authorities are saying we need this. You know, we're going to hold companies accountable. And interestingly, in bribery cases, like at Siemens, what happened was they were not charged, actually convicted of the bribery itself. They were convicted of not having a sustainable, repeatable, consistent internal controls process. That's what the fine was for. Because often in bribery cases, international bribery cases, you can't follow the money, because the money stops somewhere in the Cayman Islands or wherever. But so not having a sustainable, that doesn't mean Siemens was doing a great job in a lot of areas, but it was a very decentralized, you know, internal control process that was different in China than it was in the U.S. And what analytics and technology give us the ability to do is to monitor every transaction from every company all the time, anywhere in the world. And that's powerful. That prevents fraud from happening. Okay? So when I talk about continuous auditing versus traditional auditing, we used to have a joke at companies I worked for in auditing where they'd say, you know, well, we're continuously audited because the auditors never leave; they're always here. You know, and sometimes you're going to feel that way. Has anyone here ever been audited, either by the IRS or by in a company? Hey, yeah, you've been audited, huh?
Yeah, but it's not in America.
Yeah. Was it fun in Mongolia?
Yes.
Yeah. Was it fun being audited?
Yeah, it was at my old company, we were audited.
Yeah.
It was just like, it was a pain. They
My-
explain all your procedures and everything, yeah.
Yeah. And you got your day job, and then these guys show up and they want all this information from you. And another reason for doing this is, to take the burden off the business. They'll sit down and audit with you and ask you for 10,000 documents, and you've got nothing else to do but go find these documents. My dad used to say the auditors are the guys who come in after the battle and sheep the wounded. It's like I'm from the IRS or the audit department, and I'm here to help. But yeah, big burden. And by the way, a little tip for you guys: when you do start auditing, a great way to audit is to come into someone's office, even in the traditional. The best way to audit is what I'm going to teach you, but another way to audit that's really effective is when you come into someone's office and I'm coming in to audit you, I say, Jude, can I say Jude? Would you just bring my email up in there? It's rod.brennan@verizon.net, and I'm going to ask you for some things, and if you wouldn't mind, just attach them while we're talking here. Because that does a couple things. One, it gets you the information right away instead of someone getting back to you later. And it demonstrates to you if the person really knows where the information you're asking for really is. So, and that's a great way to get an audit done quickly. And you say, fine, I'll wait. Take your time finding it. That's fine. I'll wait to do that. Because that'll save you a lot of time versus calling 2 weeks later saying, you're under pressure to get the audit done, and Rod hasn't sent you the information. Now you got to go back and get Rod, and there's a few techniques that people use in auditing. They use the "I'm too busy to talk to you" routine. They use the information overload, like, oh, you want the security policy for our system? Yeah, here, and they bring 14 binders out and throw it on your desk and say, there you go. It's like information overload approach. So you just give them so much information, they're confused as can be. But I remember auditing, and I was an SAP consultant, did SAP work, and I'd get audited, and these auditors would come in and sit down. They flew in from somewhere, they eat all your food and they drink all over the place. And then they say to you, would you give me these invoices or something? So I go on SAP and I download it out of SAP onto a spreadsheet, and then I email it to them. Well, I can change anything on here. It's a spreadsheet. I download it from SAP, and I can modify that, or they don't know that's a sample. So that still goes on today, because a lot of times we're not giving the external auditors access to the system because we don't want them to find out about other things. And yet, they're someone we hired with independence under an NDA, a non-disclosure agreement. So we used to train, we gave our auditors at Siemens, we gave them full access to our SAP system, read-only access, so they could get information to do their audit. Very efficient, and it's what we should do. What are we hiding from our auditors? And by the way, coming out of this, fine, and that's why I got a great opportunity to work on analytics and do exciting things at Siemens around this, because they became probably one of the most compliant companies in the world, because they came from over here with problems and had paid this fine, and then invested a huge amount of money in putting good controls in. So, that's an interesting investment strategy. Invest in companies that are under investigation, and when the stock falls. And then a lot of them will go under, and Ron and some of the others, but the ones that come back way stronger. And that was the case with Siemens as well. So, but here's the kind of things we're talking about here is, traditional audit is observing events as part of a periodic or annual review. Sometimes it's a 3-year review. It's as opposed to continuous auditing, which is observing close to when it happens. Manual reporting of findings when observed in periodic reviews versus automatic alarming when exceptions occur. And a concept that will be on the exam that I want you to get is this idea of it's not enough to find things wrong. It's what you need to have is automated, escalated alerting. Okay, very important, because if you don't have that, all you're doing is providing information. You're saying to Petro, hey, we found this wrong, you ought to fix this. That's not a control. But and I'm going to show you this on a system in a minute, an actual system, where what they have is closed loop escalated alerting, which says if you don't fix this issue within 3 days, it's going to escalate to your boss, or it's going to be investigated, first of all, if it's a major issue, or if it's a potential fraud. But if you don't fix it within 3 days, it's going to escalate to your boss. And if you still don't fix it, it's going to go to the CFO of the company in 5 days. And that changes behavior, and that creates a control. You know, and a control is only something that really controls something and changes behavior. We have a lot of technology out there, BI technology, business intelligence, artificial intelligence, where we're giving a lot of information to people, but we're not forcing them to take any action or to change any behavior. And if you don't change behavior, you're not really changing the process. And the truth is, most business people are way too busy to worry about, you know, little dots, outliers on reports they get, probably thousands every day. So you drive compliance, you drive conformance to processes, which improves the business. Okay? So we do, in traditional audit, we do this sample review that you all said you did. In continuous, we do population review. We capture data from each process separately. We try and integrate across processes. So for example, when you think about auditing a process, think about it end to end, from order to cash, from purchase to pay. You know, and because a lot of times the problem is between two parts of the process. And if you don't cover the whole process, you're not going to find things. And performing mostly manual tests and interviews, and performing repeated automated tests with low variability costs. Okay, so that you want to make sure that you're you know, doing automated things. Interviews are good to set the tone in a company, to understand what's going on, to walk in the front door and see if the accounts payable person that didn't get a big inheritance and is driving a Ferrari. You know, there's things that you're still going to observe. There's things you still want to find out. Fred, the forensic stuff you mentioned, that's the kind of stuff that, you know, you got to think like a thief, and that's harder to automate. It's not formalizable. But those are the things you want to make sure you have time to do. And I'm telling you, the way we audit today, no one has time to do that stuff. And you're going to get in trouble if you start chasing it down, because you're not going to get your standard audit plan done. You know? Okay? So those are the differences. And then we talk about continuous auditing versus continuous monitoring. And let me just clarify that for you. The thing here is, auditing, the only difference between continuous auditing and continuous monitoring is continuous auditing is an independent function by an internal or external auditor that is looking for assurance. Continuous monitoring is a business person looking for assurance, validation, process improvement, efficiencies, or whatever. And normally what we do is but the tool that you use, and this is important, is the same. You know, don't go invent another tool to monitor business processes. Use the same tool you use to do auditing, just provide an independent, secure portal to the auditor through that, okay? So it doesn't matter if it's in continuous auditing or monitoring. And when you come up with an algorithm in auditing and analytics that works, that's solving a problem or reducing a risk, then move it into the business and let the business use it on a continual basis for you know, to make sure that they have a secure audit, okay? Okay, so I'm going to just go through some of these quickly because I've kind of touched on them. But you know, what do you get out of using technology and automation in auditing? You get improved quality because you're getting company-wide coverage. You're getting hard, proven facts from first-hand sources. You're getting the data. You got, you know, don't confuse me with the facts. You got the actual data. Okay? Continuous observation and evaluation that creates this perception of monitoring that prevents fraud. Okay? And again, this fraud is a big part of this. Improved audit productivity and reduced costs, because now I don't need to fly all over the world to do SAP audits. I can do them from my desk in Bradley Beach, New Jersey, or in Florida, because I have access to all the data. I have analytics I can run. I can monitor what you do every minute. And again, I want to clarify here too that I'm not talking about the Eric Snowden type privacy issues. I'm talking about in business here, you know. And you know, my company has a right to know what I'm doing with their assets and their time that they're paying me for. So you know, so some people, some of the objection that we have to this is, well, now you know what I'm doing all the time. You know, and you're monitoring every transaction. Well, yeah. Well, if you're doing your job, that's okay. And we're not monitoring your personal life and your bank account and other things. We're monitoring what you do at work. I don't see any problem with that. And, you know, it's not an invasion of your privacy. You're working with company assets on company time. And now if they go out and start monitoring your personal life, well, that's something else. Okay, but you know. automation of the process. The other thing that you can do when I talk about continuous monitoring, that can be a continuous loop process, but there's also the opportunity just to use data mining. So before you do any audit, you go in and you say, what is the risk? And where is the risk? So if I have my 400-page audit report or audit program that they slap on my desk and say, go out, Sophia, with 4 people and get this done by next Thursday, or we're not going to make our budget and you're in trouble. But instead, if I could go in and do a little data mining and analytics and say, you know what, like I said earlier, the 3-way match looks pretty good. I don't think we're going to do that on this audit because this data shows it is. But there's something funny going on over here, to Fred's point earlier. So let's go investigate that deeper. And now I'm modifying the audit based on data and information I have on a risk-based approach. And then if I do find something, then I put analytics in that prevent that ever from happening again. Now understand that black hats and people who did things wrong aren't stupid, and they're going to figure out how to, if you nail down one area, they're going to go try and commit a fraud somewhere else. So it's a continuous. And one of the tragedies that I saw happen is we would put in and find $700,000 of duplicate invoice payments with a system the first time we ran an automated system, right? And really find $700,000. And then we wouldn't find anything else. And some brilliant manager would say something like, well, we ought to get rid of that continuous auditing system because it's not finding anything anymore. I'm like, really? It's not finding anything because no one's going to do something wrong when there's a system in there. It's okay to tell people there's a system in there. I used the example here in Rutgers when I was here and I go drive home down the main street there in Rutgers and I see those lights turn pink. And I just, I can make that, I shoot through, right? And then I get in the mail, this happened 3 times, I get in the mail this little piece of paper that has a picture of me in my car coming into the intersection with a red light. Then there's a picture of my car in the intersection with a red light, and then a picture of me exiting the intersection. And then it has a little thing down below with an 18-second video that shows me driving across the red light. And then it has a little thing underneath that says, if you'd like to contest this, please call. No, really, I'm going to contest that? They nailed me, And so I say to myself, that happened twice. So I said, if I'm just taking my chances with some cop after lunch that has tryptophan in his blood and sleeping at the, he's not going to see me go by, that I might take my chances. But I'm not, forget it. I said, that changes the way I drive. I am never going through a pink light or a yellow light here in Newark again. But, and then what's that? Continuous monitoring, right? It changes your behavior. You know the camera's there, you're an idiot if you go through that because they're going to take a picture of your license plate, they're going to run it through electronically, and they're going to send you a notice, and they're going to fine you. That's continuous audit. But it did change your behavior. But people say that. They say, hey, we put this technology in this light, and we made $1 million the first year. Now let's get rid of it because no one's running lights anymore. We're not making any money. Now is that ludicrous or what? Okay, so then user, and I want to tell you these tools today, one of the objections you're going to hear is that, oh, well, you guys don't have technical skills to do this stuff. But let me tell you, nothing about technical skills. These tools that we're going to show you are no harder, other than sometimes getting the data from IT. They're no harder than using Excel or Word or what you do on your phones every day. So this whole idea that you need, geeks to do continuous auditing. And many of the firms break up their groups into, you'll see this when you get into firms, they have the IT auditors separate from the auditors. I think they ought to bring those folks together because you don't really need, now you do need data scientists and technologists to get data sometimes, and we'll talk more about that. But in terms of doing the audit, this stuff is not hard to do. If I can do it, anyone can do it. All right, reduce client effort. We talked about that earlier, where the client doesn't have to spend hours and hours. Allocation of monitoring audit effort as close as possible to the root cause, so we're finding things right away. And of course, this prevention of fraud through this perception of monitoring. Get that concept because that'll be in the exam too. That you stop fraud by creating the perception of monitoring. You don't stop fraud, collusive fraud, by sampling. Okay. Because, or by even internal controls, because they're all based on 4 eyes principle. There's collusion going on, they're disallowed. Okay? And attract top talent. You're a different generation. I shared that earlier. You're the generation that's going to change this. You're a generation that values quality of work life. you know, I don't think you guys, you might do it for a year or two to get your foot in the door, but I don't think you're going to want to be working 80 hours a week or traveling. I know when I say travel, some of you probably say, yeah, let's do that, you know, but it gets old. You know, you're not going to do that. You want to have, you value your relationships, and more power to you. That's what we need. That's what we got to change that culture, and it's not going to change by old folks like me. It's going to change because we're the ones that say, hey, I put my time in, and you're going to do the same thing. You know, I worked my butt off for 6 years in the firm. You know, so that's my expectation for you. But I wouldn't do it. You know, don't lose your family, your relationships over your job. It's not worth it. Okay, so let's look at a traditional audit. So in a traditional audit, what happens is we have business risk over here, we have time over here. And what happens is we have some level of business risk in our organization. And we know the auditors aren't coming for a year, so I'm not going to worry about it. So we do migrations for IT, meaning we put in new IT systems, and we want to test them out, so we open up the controls, and we forget to close them again, so that people can get business done and don't get stuck. And so the risks tends to go up. Then the auditors come in, they get 350 findings that are way late. You know, they may have already been corrected, or maybe we're not going to bother with them. So we start working on that, and when tightens the ship up, it goes down again. Then the risk creeps up again because they're not coming for another year, and then they come and it goes down again. But when we start to use continuous monitoring, I like this chart, but what happens is the cost, the efficiency, and the risk drops precipitously, and the cost of monitoring drops. So, you know, this idea that, you know, these systems cost some money to put in, but, you know, they're actually not that expensive systems. You know, you can buy ACL, you know, a client on ACL for a couple $100. You know, you can buy, you know, even new versions of SAP's GRC tool for a computer. And you don't use that in more mid or larger company. They're not that expensive, and they're not proprietary anymore, because if you can do a little coding in VBA or SQL, the most widely used continuous auditing tool is Excel with macros. You know, so you know, you talk about small businesses, so you don't need to be a rocket scientist or spend a lot of money to do this stuff. You know? And in a small business, that makes sense. But so what we do is we start to drive down the cost of doing the audit. This is some studies that were done with PwC. So these groups recognize that we need to make this change. They're saying that 95% of them say continuous auditing and monitoring are key responsibilities going forward in the future. But I think we're stalled a little bit because we really don't, you know, we don't know how to change to turn this monster on a dime. Just think about it. You develop an auditing process that relies on bodies and hours and templates, so that when you join the firm, they can give you a template. You can go out immediately and execute an accounts payable audit, because there's 45 things that researchers have done, and they got the blessing of the PCOB, at least on the methodology. So it's the inertia of the familiar. To change that is expensive. And what happens is, as the change comes, sometimes busy auditors just say, hey, that's great that you're doing this technology thing, but we don't have a way to incorporate that in. So just go sing. Go do what you were doing. And that's what they're going to tell some of you when you challenge it. When you come in and say, hey, why don't we use ACL? Why don't we use Prove a Biz Writer? Why don't we go on blockchain? And I'll tell you right now, we're going to talk about this later, and I hope I get into it today, but this blockchain thing is revolutionary. And the audit, I was with PwC in New York yesterday, the audit companies don't know what to do with it because it's brand new, it doesn't fit the process, and they're trying to figure, they're scrambling to try and figure out how to adopt it. So, and notice fraud detection's on there too. We know we're not finding fraud. We got to do something different. Someone said insanity is doing the same thing you always did, expecting a different result. The majority of companies are challenged to automate manual controls and are much less aggressive in moving to reliance on company control. So the automation is a challenge, and I'm going to submit to you it's mostly a cultural challenge. So the culture has to change. It's not a technology challenge. We've had the technology for years. Even Michelos Vassarelli here in 1989 developed one of the first continuous monitoring systems. Maybe he shared this with you on AT&T's billing system, and it was a huge success. But the problem was that AT&T had 60 different billing systems, so you had to repeat that technology in all of them. And what I like to do is try and drive common processes because of the control environment. So we all do warranty accruals the same way, then we can write one analytic that measures warranty accruals across an entire company, or entire organization, or multiple companies even. And that's a big motivation for people to change the way they do processes. There's nothing creative about doing warranty accruals. So, and you'll see in large companies when you go to audit them and work for them, everyone does it differently. Like it's a creative process or something, and it's not. So that was from KPMG. And then when I talk about this sort of journey from totally manual, and no one's totally manual, across to this amorphous continuous auditing thing, in many cases, it's things like you start out with having an ERP system that's automated. Then you have exception and error reports. Then you have dashboards, and that's big. Is be able to look at a dashboard and see what's going on in your company. And I'll show you some of that. And then you move across to real-time auditing and real-time reporting. And often the business is ahead of the auditors. And you know why that is? Because audit departments don't have any money. You can't go as you're the head of audit. And you go to your company and say, "I'd like $5 million to put in an automated auditing system." They'll say, "Yeah, sure, go do what you were doing. You're doing fine. We haven't had any problems." But if you're a business and you get an external audit report that says that you have no process for securing your SAP system or for segregation of duties in your business, you're going to be quick, because you have to respond to that. You're going to be quick to develop, to spend some money, put in some technology to make sure you have it. And the business has money. So a lot of times the auditors are behind the business in using monitoring. And businesses, everyone knows what the Internet of Things is. The future that we're going into now is changing rapidly, and it's all going to be around analytics and sensors and continuous monitoring and smart engines. GE now, instead of selling engines for planes, they're selling hours on engines, hours for power, or power for hours. They're selling time on an engine that they put on a plane. They still own the engine, and they sell you it by the hour, and they monitor the efficiency of that engine all the time. Your refrigerators, your coffee makers, they're all smart, and that's where we're going. That's where the world's going. And that opens up a whole nother era of opportunity for fraud and analytics. The scariest ones are you have a pacemaker, I hack it, I don't like you, and I drop you. I mean, that's a concern people have. This is So everything is going to be analytics, and we better get there in auditing. We should be there already, but everything is going to be interconnected, interoperability, across everything. So it's exciting, And a lot of companies are struggling now. How do we audit interoperability? How do we audit the Internet of Things? So exciting thing. So this is an example in a large multinational company where the audit department has a few systems in place, but the business, the monitoring section of the business, that business part of it, they've got all kinds of monitoring things in place because they had issues with T&E or order to cash or GL finance, and they used it not just for auditing purposes, but to improve the business. And these are some from an actual company, actual example here. So pull out your clickers here, okay? And I'm going to ask you a question here. This is both for attendance and see how smart you are. See how smart this class is. All right, Tiff, where does this thing come from? So what is not a benefit of continuous auditing? This is like the IBM Watson questions I talked about. What is not a benefit of continuous auditing? Hold on, I got to get it back up again. Oh, now we can. Yeah. Aha, very good. Give yourselves a hand. Now, we'll put answer A and we'll put answer C. Fail then. No. Yeah, so I said that so it's real time or lower. You're going to get a much higher level, an exponentially higher level of audit precision when you use continuous auditing and monitoring. Okay, and continuous auditing does do usually population review, but not always. So you did answer that. And auto alerting is this idea of closed loop escalated alerting. Get that idea because that transforms a control, something from being information into being a control. Okay? All right, what does automated audit tool look like? So let's take a look at some of these tools and what they look like. And these are actual tools. So this is a set from a large company. Don't worry about reading it, but of 100 analytics for purchase to pay. Okay, that's what you'd address corruption with. That's what you'd address payment issues with, any procurement issues, any remittance type issues. Okay, and it has everything from SOD, which is segregation of duty rules. That's around making sure that we have 4 eyes principle, which I already said isn't that effective. Okay. To IT type controls and parameter controls that are turned on. So, you know, the duplicate invoice check is on in SAP, those kind of things, or payment things. And then also banking controls and money laundering controls. Anyone know what AML is? Anti-money laundering laws, huge issue. People are transferring money all over the place and corrupting. Okay, so these were put in order to address corruption issues. Okay. And the way it worked was, this is a dashboard that comes up. So if I'm the CFO of a company consolidating some 1,000 companies, this shows you on all those 100 controls who is at risk here or who isn't in compliance. And this green section here is based on a risk formula. So someone asked earlier, you know, if you get thousands of things wrong, where do you know where to start? So what we do is we say, if we see these kinds of things or these kinds of things in combination, then I have a risk. Okay. So if I'm a CFO of a company, I own, or the CFO of the company overall, and I own this button right here. This is outside. There's some risk here with that company. I click on that. This is just, I'm just showing you an example of an automated tool. I click on that, and I get a listing of what things are wrong. So, for example, here it says that the POs were created on or after the date of the invoice receipt. Well, that's a problem, right? So I already ordered something, I already got an invoice for it, but I never had an authorization to buy it. And there were maybe 17 occurrences of that. Now, that could be a fraud, that could be just a mistake, it could be someone not following the process. Okay? And if it is something we think is a fraud, it immediately goes to investigation. But if it's not, what happens here is that these 17 issues have to be corrected and documented as corrected in the system within a week or so. And if they're not, they escalate to your boss, and then to your boss's boss, and then and this is an actual system working in an actual Fortune 100 company. They are escalated to the CFO of the company. And I'll guarantee you, and correct it, and I'll guarantee you that nobody is committing a fraud, is perpetrating or concealing a fraud on any of these 100 things here. Because every transaction is monitored every day, and there's a follow-up procedure for it. Now tell me how better a level of control that is than taking a sample of 30 once a year on a process with hundreds of thousands of transactions. You know, I mean, there's no comparison. And I lived with this firsthand because we worked with the system, and it really works. And if someone makes a mistake, they just forget to write the PO, it's going to stop you right there, and it's going to be found. Okay, that's one example. And it also gives you a lot of interesting information about the company. Here's another example, and this is with a third party, and this is an actual system working in a company, and I had an opportunity to work with this. And what this system does is it takes a shared service center. So more and more, everyone know what a shared service center is? Anybody know what a shared service center is? Shared service. That's where you'll see that a lot when you go into audit, where, you know, instead of having company division A, B, C, and D all do their own payables, we combine them in India or Florida or China somewhere, and we set up a shared service center to do all back office things. So you'll learn that when you go and do auditing. A lot of times you'll go and just audit at the shared service center, because all the back office things. And they've added more and more things to the back office. So now they're doing closing books there and doing reporting there, which again makes even a better opportunity to use automation, because now I can do one place, I can put one system in and measure all, and this is the case here. This is a system that does, you know, $100 billion worth of business in the company. And then they bring in prohibited listings, OFAC listings, which are corruption index listings for FBI most wanted, prison addresses, scam vendors, high-risk vendors, okay? and they create, again, a risk algorithm. This is a continuous monitoring tool. So they look at things like initials in vendor's name, low number POs, high-risk zip codes, prohibited vendors, prison addresses. You wouldn't believe how many times you get a prison address, an employee that's also a vendor, and the address is a prison address. And you send a note out to someone, and they say, oh, it's okay, don't worry about it. You're like, what? So, and then things like even dollar amounts. If I see even dollar amount, that's a concern from an audit standpoint. If I see multiple payments of the same amount, if I see no PO, year-to-year comparative spends. Anyone know what Bedford's Law is? You ever heard of that? Yeah. Okay, that's used a lot in auditing. If you have low, you should see low numbers in a database, in a business database, and you see a lot of high numbers in the first or second position. That's an indication that someone's manipulated that data. And even better is what we're going to talk about with blockchain, and that's cryptographic technology. So if I take the book War and Peace, and I run it through a SHA-256 hashing, it creates a 64-character code for War and Peace for the entire book that's immutable and can't be reversed. Okay? And if I change one letter, instead of the in the second paragraph, third page, I put THEE, I will get a totally different 64-character number. So cryptographic technology is what the blockchain and Bitcoin and these other things are built on. And if I do that, and I can't reverse it, so I will know that you messed with War and Peace by changing one letter in a 700-page book, because I get a totally different, it's not like 1 0 is different, totally different 64-character cryptographic key hashing key. So, so those kind of things are useful in at least getting an idea if there's a problem with the data. Okay, and then what happens is we have a risk score for this, and we say if anybody has 150 points, okay, so you get 50 points at Bedford's Law, because it doesn't tell me for sure something's wrong, but you get 150 points if an employee name matches a vendor name. Now that's a problem, right? If I'm an employee and I'm also doing business with the company, that's 150 points, so that one goes right to fraud investigation here, okay? And any combination. So this is where, at first, if you don't find a lot of things, you can change this score and make it 200 points or something, and only investigate the higher ones, and then drill down as you get better and better. And that's the process you want to use, to your point, Fred, so you don't get so many things you don't know where to start. Okay? And then you get a score here, and then we follow up on these things. So, I had the experience where I go to follow up on them, and what we didn't have with this was closed-loop escalated learning. I go to follow up with them, and people would say things to me like, well, this person is a vendor and an employee, and we just paid them an invoice in even dollar amounts for $250,000. What's going on? And the address they have is a prison address. And you get someone to write back and say, oh, it's okay, don't worry about it. But if you don't have the closed loop where they have to fix it, they have to provide an explanation, or we're going to investigate it, then you don't have a control. All you have is information. So, and the weird thing is it can happen, because if you have an invoice, if you have a vendor address that matches an employee address, it could be that I was a vendor, I left and joined the company, and so there's still an address left because they keep historical addresses. So you got to look at the timing of it. Or I could have been an employee that left the company and started my own business, and I appropriately, separated. So you follow me? So, and then what we did with this was even cooler. Is then we went out to Google Map, and we looked at where so this was one where they had $26,000 of even payments, and they were employees that matched the vendor address. So we go on Google Map and look at where they live. So they live in this mansion somewhere, maybe, because lifestyle changes are one of the biggest indications of fraud. When people start, because people steal money and then they do something with it. So they suddenly, you come to work in a Prius one day and you're driving a Lamborghini the next, and you're a whole class of one of which few of them here. Right? So that's an actual system that works, and again, you're out of your freaking mind if you're going to try and commit a fraud here, because you're going to get caught, Now, another interesting one, actual systems that work. Yeah. Question? Oh no, I thought you were next. Okay. Another one that's interesting is, and I talked about this earlier, so this is called SAP HANA. This is in-memory optimized analytics. And the way this works is we take all of the databases or data stores or data warehouses, and we run them through this SLT server, and it converts or optimizes the data into RAM memory. And then we produce all kinds of reports in real time. And I've seen this where you can be on an iPad, you know, on your porch at the beach, and you can see instantly everything that's happening in your company on a dashboard, like this dashboard here, you know, and that could be Tableau or whatever. Now that's great because it creates this dashboard, but again, it doesn't change behavior. It doesn't make someone do something different, and it really doesn't provide a control, because if there's something wrong in that and you're too busy to deal with it or you don't see it, I've not improved the assurance or control in the company. So what we do then is we add this concept that I talked about, closed loop escalating alerting. So I have the dashboard, but I also have trigger points on here that say if Naren, you know, does this and this in combination. So for example, if a C-level executive approves or submits more than 5 month-end entries of more than $10,000, send me an alert, and that becomes a closed loop alert. And even though it's after the fact, you know, maybe or I have I have a receivable that's over 30 days. Okay, that's a control issue, but it's also a business issue for what? For cash flow, right? Because if I have a receivable that's over 30 days, an uncollected receivable, that's a compliance issue, but it's also a cash flow issue. So I send an alert both to the audit department saying I have this receivable over 30 days, and I send it to the salesman responsible for collecting that receivable. And now I've improved my cash flow and I've improved my control. So, you know, but what this, so if you have alerting, closed loop alerting, what can happen too is it can be in the subledger. I find a mistake in the subledger before it's posted to the general ledger. Now I've taken what we would call, and you remember this from your first audit class, I take a detective control that really becomes a preventative control because I'm catching it before it gets posted to the ledger and making sure it's correct. Yeah. Okay. So, and then these are some of the type of reports you can do with these things, but again, if it's just a report, you can do it on project management and other things. If it's just a report, then you have to change behavior. Okay, so that's a concept that's important. Just going to go another 10 minutes here or so to get you out of here. So, now back 15 years ago, a company called CISCO, which used to be the darling of Wall Street, they went and developed a continuous auditing process, an assurance process, under John Chambers' group, and they were able to automate their systems enough that they were able to take and go to real-time reporting. And that's really the end game here, is that if we can provide assurance instantly and on a continuous basis, we can close the books a lot faster. The estimate is that it cost a company, a larger company, $1 million a day to take 1 day off the closing process. When I started as a controller or accounting supervisor in 1982 in Southgate, California for Armstrong, we took 22 or 23 days to close the books. And we thought that was good in the flooring and interior furnishing business. Today, if you got a 7 or 8 day close, that's really good. But if the investment community knew that we could close the books instantly, they would insist on that. Did you guys do that case, by the way, in any of your classes? Because we might do that. Did you hear about the CISCO case? It's a really interesting case.
It doesn't sound.
Yeah, okay. Well, we might do that in class. It's an interesting case of how they did it, and some things that went wrong with the way they did it. But they did basically continuous auditing and monitoring in order to reach a continuous close. And think about the implications for that for accountants, for the investment community. We could close the book sooner, or if we had real business intelligence, you know, that we could get instantly, how that would affect the markets. You know, huge impact. So well, we might do that case. So, and this is just some, you know, what is a virtual close? This is from John Chambers' illustration, but they did this in 2001. The technology is 10 times better now. So the technology was there in 2001 to do this. Okay? Also, a lot of people don't know this, but in SAP, and by the way, one of my tips for success in your career is learn SAP, learn something about it. If you're with a company, either auditing a company or Oracle, you know, the big ones, because some, I don't know, it's 80% of the large companies use either SAP or Oracle, and they're fascinating systems, and in order to be a good auditor, you know, and I had a great advantage because I had a consulting background within SAP, to do automated auditing, because you know where the data is, and they're not that complicated systems, but learn them because, you know, I got an offer to go to work for Computer Science Corporation before I went to work for Siemens as a consultant on the largest SAP project, which was the Army Logistics Program, and I wish I could, because it would have been a consulting role that's still going on. We're still installing the Army Logistics Program, you know, 15 years later, but you know, and I wasn't a really good technical person. I just had some experience with SAP, and I was a U.S. citizen. That was important to the military. So, but fascinating system. And when you configure it, it's not complicated. You just say, I want to turn on trade receivables. Yeah, turn that on. Yeah, and you pay a lot of money for it. And you turn on all this stuff, but you don't understand the underlying processes that need to be in place when you turn it on. And that's what makes SAP complicated. It's actually a fascinating system developed by good German technology. But it has a tool in it called AIS, Audit Information Systems, which is actually a semi-automated auditing program within SAP, and it comes delivered with all of them. And it has a systems and business and financial audit built into it. And what we did at Siemens is we used this technology to develop automated audit scripts for SAP. So, and what happened was the Big Four and SAP co-developed this about 7 or 10 years ago. And it was getting really good, and the Big Four, I think, got concerned that if this gets so good, they won't need us anymore, and they backed out of the project. SAP backed out because when Sarbanes-Oxley first came out in 2002, there was concern about liability. If you say, you know, we have this tool, and if you use this, you'll be compliant with Sarbanes-Oxley, or you imply that, and then you fail Sarbanes-Oxley, you could theoretically, you know, with a good lawyer, money goes around, you could sue, sue SAP for misrepresentation or something. But anyway, that's a tool in there, and it's another sort of, you know, continuous monitoring, but it's not in the script. You have to put it in the script, and then you have to add that closed loop alerting. So these are some examples. This is a great example, and I'll probably finish with this, but this is a great example of where continuous auditing really makes sense. This is from Wells Fargo. So what happened was Wells Fargo has 3,000 branches. And what they would traditionally do is they take 15 or so auditors out, and they try, working unbelievable hours and traveling, they'd go in and they'd audit 600 of those 3,000 once a year on a standard set of, I'll call them commoditized controls. So what's more of a commodity than a bank? You know, a bank branch that does everything the same. It's kind of cookie cutter. So now what they did is they wrote analytics to now start to monitor all 3,000 branches on all of the analytics continuously. And they had a 500% impact on coverage, because instead of doing 600, now they're doing 3,000. They also went in and the audit hours that they needed to spend now went from 26,000 audit hours down to 2,500 audit hours, and that was mostly just forensic analytics, looking at the analytics. So that was a 90% increase. Then they went from writing 600 separate reports, 600 audit reports, to writing one on the whole state of the art out in banking for a 99% improvement. And they went from, and this is the part that gets some resistance, they went from 15 auditors to 2 auditors to do that job. And I'll argue too that they probably reduced fraud significantly. And branch bank fraud is a common type of fraud, because you do credit returns and things like that. So they were able to, and that's not even included in here. This is savings without addressing fraud. But I guarantee they impacted fraud, because now there's an automated thing looking at every remittance and every return and every bank credit, and so you're an idiot to try and get fraud there. So that's an actual example. Now you say to yourself, why doesn't everyone do that? You know, well, there's cultural resistance, because there's auditors that say, I'm going to lose my job. And I'd argue you're not going to lose your job. You're going to trade up to work on the forensic things that these analytics aren't going to find. And you're always going to be able to trade up, because there's a lot out there that we're not finding. So That's another example of a continuous audit. And if you need a value proposition for it, and this is one for an actual automated project, large automated project, if I have out-of-pocket savings, this is just an EDA or a ROA type thing. If I have out-of-pocket savings, reducing compliance costs for internal auditing because I don't have to travel as much. Just as an example, if I have 400 or so auditors and they're got a sunk cost of $150,000 a year to field those auditors, and with travel and burden, and that's costing me, $20 million a year from just my internal department. Never mind what I'm paying for my external. If I could just reduce by 25% the travel and stuff there, okay, and even if I paid $1 million for the audit, that's $19 million a year that I could save over, and $100 million over 5 years in my auditing costs. Just by, it doesn't mean we go off the road completely, we just reduce it by 25%, huge impact. And I'll argue anybody could reduce the audit effort, and the auditors would appreciate it because they could stay home with their kids and their boyfriends and girlfriends a little more, okay? And then take a little bit off for the business compliance costs, because now I don't have to come to you and bother you and take your time, Stephanie, doing the audit. You can do your job, and I don't have to ask you for information. And then let's say that on your external audit fees, you can reduce your external audit fees by just 4%. It's a windfall for them because the external auditors, what's happened to us at Siemens, they wanted to use the technology we put in because it's more efficient for them too. And they come in and say, let us use the technology too. So they take 4% off. This has a payback within 1 year. And if you take 5% of revenue below the line here for fraud, okay, that you're saving in fraud, and if you don't believe it's 5%, cut it in half. And if you don't believe it's 2.5%, cut it in half again, and then cut it in half again. I took here 1/2 of 1%, 1/2 of 1% of revenue, and look at the return this business would have, $866 million of savings. Now this is a $100 billion company, but $866 million of savings just on fraud alone, not to mention the out-of-pocket costs. So this is not a hard sell. It's not a value proposition, except that most companies don't think that any fraud is happening in their business or that they have any real problems because they have a clean attestation from the internal and external auditor, so they're not worried. See? And then there's also, you can get automated audits off the internet. You can go on and look up audits, and you can get, safety audits, fleet vehicle inspection audits, risk assessments, on apps. And one of the PhD students here, Ryan Teeter, who's now a professor out in Utah, University of Utah, or Brigham Young, one of them, and he thought of this sort of logo type concept in his PhD thing on this, where you take sections of audits and you put together your audit just by pulling an app off of here, an app off of there, and have an automated audit like a Legos, like Legos. You just piece together the audit that you have. So that's a look at at different types of audits. Now I want to spend some time talking with you about blockchain, but maybe we'll let you get out of here the first day so you can give your professor a good rating. Like the first day early. But let me stop here, because I'll pick up next week. We're going to have IBM.